Hey, are you wondering if you are emotionally fit to follow Warren Buffett's investment strategy? In this video, I'll share with you 3 emotions that can make it tough to invest like him. So let's dive in! Warren Buffett, the best investor in the world, often says that temperament is more important than intellect in investing. His investment approach has helped many other investors succeed in the stock market. However, what works for Buffett and others might not be the best fit for you. So here's the question. Which emotional traits would make it hard for you to follow Buffett's investing style? Social proof is the concept that people often mimic the actions or views of others, especially when they are unsure what to do. It's like when you spot a long line at a restaurant and figure it must be good since so many people are waiting. It's a way of making decisions based on what others are doing. If you are someone that seeks safety in numbers, it will be tough to follow Warren Buffett's investment strategy as it often goes against the crowd. If you rely on social proof, you might be tempted to go with the flow, buying stocks when everyone else is and selling when they panic. In his 1986 letter to Berkshire Hathaway shareholders, he famously advised, "Be fearful when others are greedy and greedy when others are fearful." This means you should be careful and refrain from buying when everyone else is rushing to invest because prices are likely high. On the flip side, you should think about buying when others are fearful and selling because prices are probably low. This approach helps you to buy low and sell high, which is key to making money in the stock market. To succeed in investing like him, you need to be naturally contrarian and be right. While being positive when everyone else is negative can be good, if you are too positive, it can hurt your investment portfolio. Admiral Jim Stockdale is known as a war hero in the US. During the Vietnam War, he was captured and routinely tortured as a prisoner. At one point, he tried to kill himself because he was scared he might give up sensitive military information under torture. Years after he was freed, Stockdale was asked in an interview how depressing life in prison must have been. He pushed back and said, actually, it was never depressing at all. He never lost faith that he would make it through, that he would be set to be free and reunited with his family. Pure optimism, right? Not really. When he was asked who struggled the most in prison, Stockdale said it was easy. It was the optimists. The prisoners who always said, "We'll be home by Christmas," were the ones who felt crushed when another Christmas passed without freedom. They died of a broken heart, Stockdale said. He said that there is a balance between having unwavering faith that things will improve and accepting the harsh reality, no matter what it is. Things will improve eventually, but we won't be home by Christmas. That's the balance, planning like a pessimist and dreaming like an optimist. The reason why I'm sharing Stockdale's story with you is because the same principle applies when you adopt a Warren Buffett's investment strategy. Successfully investing like his requires optimism and pessimism to coexist at the same time. If you are like most people, you probably look up when buying a stock, asking yourself, how much money can I make by buying this stock? The mindset to have when following a Buffett-style investing is to look down before looking up and ask yourself, how can I pay a price that minimizes the risk of losing money with this investment? Even if you believe that this stock will be worth more in 10 years than it is now, you still want to buy it with a margin of safety. A margin of safety is a buffer between your estimated value of the stock and the price you pay. If your estimated value of the stock is $100, you won't buy it at $100. You'll aim to buy it at $50 to give you a 50% margin of safety. This is important because even if things don't go as planned, you will still be in a good position since you won't lose money. It also sets up a scenario of low risk, high returns if your analysis proves correct. If you invest like Warren Buffett and expect a stock to go up in the next 6 months after you bought it, you will find it hard to follow his investing strategy. Warren Buffett's strategy is to buy stocks that have a disconnect between their estimated value and their current stock price. This occurs when the company is facing a short-term issue, prompting many people to sell the stock. When Warren Buffett buys those undervalued stocks, he doesn't expect them to reach their estimated value as it might take time for the market to recognize its errors and adjust the stock price. Buffett also believes that if a business does well, the stock eventually follows. This is why he is a long-term investor, sticking to wonderful companies as long as they remain wonderful.
You don't really need brains.
What do you need?
You need the right orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
Pardon me?
And what do you think
I
about?
think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it, because I'll buy more.
I recently made a video explaining why long-term investing is key for your investing success, and you will find it either somewhere on the screen or in the description. This is it for today, guys. If you got value from this video, feel free to drop a like, and if you want to receive more content like this, feel free to subscribe. Thank you all, and peace out!